Health-related revenue raisers.
Excise tax on high-cost employer-sponsored health coverage. For tax years beginning after December 31, 2017, the bill would place a 40% non-deductible excise tax on insurance companies and plan administrators for any health coverage plan to the extent that the annual premium exceeds $10,200 for single coverage and $27,500 for family coverage. An additional threshold amount of $1,650 for single coverage and $3,450 for family coverage would apply for retired individuals aged 55 and older, and for plans that cover employees engaged in high-risk professions. The tax would apply to self-insured plans and plans sold in the group market, but not to plans sold in the individual market, except for coverage eligible for the deduction for self-employed individuals. Standalone dental and vision plans would be disregarded in applying the tax. The dollar amount thresholds would be automatically increased if the inflation rate for group medical premiums between 2010 and 2018 is higher than the Congressional Budget Office estimates in 2010. Employers with age and gender demographics that result in higher premiums could value the coverage provided to employees using the rates that would apply using a national risk pool. The excise tax would be levied at the insurer level. Employers would be required to aggregate the coverage subject to the limit and issue information returns for insurers indicating the amounts subject to the excise tax.
New employer reporting responsibilities. For tax years beginning after December 31, 2010, employers would have to disclose the value of the benefit provided by them for each employee's health insurance coverage on the employee's annual Form W-2. Additional hospital insurance tax for high-wage earners. For tax years beginning after December 31, 2012, the HI tax rate would be increased by 0.9 percentage points on an individual taxpayer earning over $200,000, $250,000 for married couples filing jointly. These figures are not indexed.
Surtax on unearned income. For tax years beginning after December 31, 2012, a 3.8% surtax called the Unearned Income Medicare Contribution would be placed on net investment income of a taxpayer earning over $200,000, $250,000 for a joint return. Net investment income would be interest, dividends, royalties, rents, gross income from a trade or business involving passive activities, and net gain from disposition of property, other than property held in the trade or business. Net investment income would be reduced by properly allocable deductions to such income. New limit on health FSA contributions. The amount of contributions to health flexible spending accounts, FSAs, would be limited to $2,500 per year, effective for tax years beginning after December 31, 2012. The dollar amount would be inflation indexed after 2013.
Restricted definition of medical expenses for employer-provided coverage. For purposes of employer-provided health coverage, including health reimbursement accounts and health flexible savings accounts, health savings accounts, and Archer medical savings accounts, the definition of medicine expenses deductible as a medical expense would generally be conformed to the definition for purposes of the itemized deduction for medical expenses. But this change would not apply to doctor-prescribed over-the-counter medicine. Thus, the cost of over-the-counter medicine other than insulin or doctor-prescribed medicine could not be reimbursed through a health FSA or HRA. In addition, the cost of over-the-counter medicines other than insulin or doctor-prescribed medicine could not be reimbursed on a tax-free basis through an HSA or Archer MSA. These changes would be effective for tax years beginning after December 31, 2010.
Increased tax on non-qualifying HSA or Archer MSA distributions. The additional tax for HSA withdrawals before age 65 that are used for purposes other than qualified medical expenses would be increased from 10 to 20%, and the additional tax for Archer MSA withdrawals that are used for purposes other than qualified medical expenses would be increased from 15 to 20%, both effective for distributions made after December 31, 2010. Modified threshold for claiming medical expense deductions. For tax years beginning after December 31, 2012, the adjusted gross income, or AGI, threshold for claiming the itemized deduction for medical expenses would be increased from 7.5% to 10%. However, the 7.5% of AGI threshold would continue to apply through 2016 to individuals age 65 and older and their spouses.
Deduction for employer Part D would be eliminated. The deduction for the subsidy for employers who maintain prescription drug plans for their Medicare Part D eligible retirees would be eliminated for tax years beginning after December 31, 2012.
Industry-specific revenue raisers. The following revenue-raising changes would be imposed on health-related industries. A new deduction limit on executive compensation would apply to insurance providers. If at least 25% of the insurance provider's gross premium income is derived from health insurance plans that meet the minimum essential coverage requirements in the bill, covered health insurance provider, an annual $500,000 per tax year compensation deduction limit would apply for all officers, employees, directors, and other workers or service providers performing services for or on behalf of a covered health insurance provider. The limit would apply for remuneration paid in tax years beginning after 2012, with respect to services performed after 2009.
Pharmaceutical manufacturers and importers would have to pay an annual flat fee beginning in 2011 allocated across the industry according to market share. The schedule for the flat fee would be 2011 $2.5 billion, 2012 to 2016 $3 billion, 2017 $4 billion, 2018 $4.1 billion, 2019 and later $2.8 billion. The fee would not apply to companies with sales of branded pharmaceuticals of $5 million or less. Manufacturers or importers of medical devices would have to pay 2.3% of the sale price as imposed on the sale of any taxable medical device by the manufacturer, producer, or importer of the device. A taxable medical device would be any device defined in Section 201H of the Federal Food, Drug, and Cosmetic Act intended for humans. The excise tax would not apply to eyeglasses, contact lenses, hearing aids, and any other medical device determined by IRS to be of a type that is generally purchased by the general public at retail for individual use.
Health insurance providers would face an annual flat fee on the health insurance sector, effective for calendar years beginning after December 31, 2013. The fee would be allocated based on market share of net premiums written for a U.S. health risk for calendar years beginning after December 31, 2012. The schedule for the flat fee would be 2014, $8 billion, 2015 and 2016, $11.5 billion, 2017, $13.5 billion, 2018, $14.3 billion, and indexed to medical inflation for later years. The fee would not apply to companies whose net premiums written are $25 million or less. The indoor tanning industry would be hit with a 10% excise tax on indoor tanning services, effective for services provided on or after July 1, 2010. Non-profit Blue Cross Blue Shield organizations would have to maintain a medical loss ratio of 85% or higher in order to take advantage of the special tax benefits provided to them, including the deduction for 25% of claims and expenses and the 100% deduction for unearned premium reserves.